Hello friends, in today's video, we will be discussing about Switchback Energy, ticker symbol SBE, and review if this stock is a good one to buy now. Before we get into details, I want to mention that Switchback Energy is a special purpose acquisition company, in short as SPAC, who have entered into a reverse merger agreement with ChargePoint Incorporated. So the actual company we will be analyzing in this video is ChargePoint, as we will eventually own the stock of ChargePoint by buying Switchback Energy stock now once the merger formalities are completed in the upcoming months. As mentioned in some of my previous videos, this is no different than other popular SPAC-sponsored companies like Helion, Workhorse, and Desktop Metal. Now let's discuss about ChargePoint and their business model. ChargePoint develops charging solutions for electric vehicles and have been in business since 2007. It operates the largest online network of independently owned EV charging stations, and the company designs, develops, and manufactures hardware and software solutions required for this. Their business model involves selling this hardware and software to property owners, building a searchable network of charging stations for drivers, and maintaining these charging stations. As of September 2020, the company operates 114,000 charging stations. So this is not just a small startup company we are talking about here today. Obviously, if we want to invest in this company today, we should be bullish about the future prospects of electric vehicles, but the good thing about ChargePoint is that it doesn't matter which EV manufacturer succeeds. It could be Tesla, NIO, Nikola, Workhorse, or any other newcomer who ends up being the winner, and ChargePoint will still stand to benefit as their charging network will be needed to operate these vehicles. So let's now look at the market opportunity and how ChargePoint is positioning itself to take advantage of this. As you can see here, EV sales in the US and Europe are projected to be 9.9% of all new vehicles sold in 2025 and close to 30% in 2030. This, when compared to the 2.6% in 2019, is a massive opportunity for EV companies to take advantage of. ChargePoint, of course, is not a pure play EV company, but is in an even better position to ride this market transition, with approximately $190 billion being the projected investment the market will be making in EV charging infrastructure by 2030. So ChargePoint's focus would be to capture as much market share as possible out of this massive market opportunity, and that would reflect in their revenues and profits. ChargePoint is also setting up a solid platform to be able to also benefit from an annual subscription model that will bring in recurring revenue for the company, in addition to the new customers that can be added to their portfolio every year. In addition, Joe Biden becoming the US president would also be a tremendous boost to the EV industry, as detailed in an article posted on Bloomberg this week. I'll put a link to this article in the description if you're interested to read more. ChargePoint is also already the leader in terms of number of stations owned and operated in the US, specializing in level 2 charging stations, in which they have a 43% market share as of Q1 2020. I have also displayed here a high-level description of the different types of charging stations if you are wondering what level 1 versus level 2 charging means. You can also see in this chart the current and future EV sales projections and ChargePoint's current and exponential future estimate of the number of commercial charging ports that they plan to install and operate in the next few years. The additional tailwinds mentioned at the right side of the chart are also noteworthy. Now let's take a closer look at ChargePoint's products and services. As you can see here, they have three main lines of businesses. The first one is commercial products, where their customers can either buy the charging stations and pay annual subscriptions for the software, parts and maintenance, or avail of the ChargePoint as a service option, which would mean ChargePoint continues to own the charging stations and the company would pay a periodic payment for the service, similar to how renting or leasing works. Then they have the fleet products, which is typically catered to large commercial fleet operators. Finally, there is the residential product line, which caters to both the single-family and multifamily markets. And here you can see the benefits that ChargePoint offer their customers for each of the product lines, And it is good to note that 62% of Fortune top 50 companies already use ChargePoint. They also have very good reviews on Google, which shows that the company's services have been well received by the market. The company has also focused on expanding into Europe, which I think would make its position as the market leader even more stronger in the years to come. And as you can see here, ChargePoint has set up their business model in such a way that they can benefit from recurring revenues in addition to the upfront payment received from their customers at the time of installing the hardware. The company collects around 51% of revenues at the time of installation and the remaining as recurring charges over a 7-year period on average. So as their customer base continues to expand, their cost of sales and operating expenses can be expected to grow at a slower rate, which would in turn improve their net profit margins. Moving on, here you can see some of their select customers who are very well established players in their respective industries. ChargePoint has over 4,000 customers in total, and it would be reasonable to expect that their customer relationships can be maintained for the long term, as switching costs could possibly be very high in this industry. So as long as ChargePoint can keep innovating and providing quality customer service, they can expect to continue as the market leader. Now let's look at the financial projections. You can see here the number of charging stations installed and the relative revenues that ChargePoint expects to make. It is obvious that ChargePoint expects a very rapid increase in their revenues, growing from $135 million in 2020 to over $2 billion in 2026. This looks pretty reasonable to me, since they are just trying to capitalize on the overall EV trend that is almost certain to ramp up significantly in the next 5 to 10 years. The revenue projections are also well diversified across product lines and geography, and from the chart on the right, it can be seen that ChargePoint is clearly focusing on expanding their European operations faster than North America. And as I mentioned before, their gross margins can also be expected to grow over time due to economies of scale, and this would be very important for the company to focus on in order to expand their net margins and cash flows in the coming years. The company also hopes to significantly reduce their operating expenses as a percentage of their revenues, which again will result in expanding net margins and cash flows. This table shows the financial projections made by the company up until 2026, at which point the revenue is projected to be over $2 billion and an EBITDA of $340 million. These are obviously projections, and whether the company will achieve these targets would be interesting to see. But I think they have a pretty high probability of meeting these targets if they continue to be the market leader in this industry. It is also good to know that the cash inflows from the merger transaction with Switchback Energy is expected to fund the company's operations until it turns cash flow positive in a few years' time. So we can assume that ChargePoint doesn't have to take any significant loans to fund their operations. And due to this, we can also use the EBITDA as a reasonable proxy to net income to perform a valuation to see what returns we can expect to make by investing the company's stock today. So to do this, let's first see what the current valuation of the company is. As you can see here, the merger transaction values the company at $2.4 billion, but we need to note that this is at a price of $10 per share. What that means is the valuation would be higher if you buy the stock at the current price, which at the time of recording this video is $16.78. So assuming the company would make an EBITDA of $340 million in 2026, we could assess what the company would be worth at that time using various price earnings multiples. As you can see, at a 10 price to earnings multiple, the company would be worth $3.4 billion, whereas at 40, it would be worth $13.6 billion. Personally, I think it is reasonable to expect the market to value the company at a 40 PE in 2026 if they achieve the targets as projected. So a 40 PE multiple would put the stock price at around $45 in 2026, which would give us an absolute return of around 166%, which is pretty impressive. And we could even get a higher valuation in 2026 or even earlier, depending on what the overall market sentiment turns out to be. Personally, I think it would turn out to be a great investment even if ChargePoint grows at a slower rate. But I also think that this is still a speculative play, so I'll only be investing 1 or 2% of my portfolio into the stock. And as seen with recent SPAC companies like Helion and Lordstown Motors, the stock price may shoot up in the near term before the merger transaction is closed. So that would be a good time to sell off a portion of the shares to reduce the overall risk and then wait for lower prices to build up the stock position again. Let me know your comments on whether you're also bullish on ChargePoint's future prospects and the overall EV market in general, and always remember to do your own research as I am not a licensed investment advisor. Hope you enjoyed this video, and if you found the information useful, I would really appreciate if you can leave a like and subscribe to my channel. Have a great day, and I'll see you in the next video.